So, needless to say, I'm actually very excited about this live stream. I'm always excited about live streams, but even more excited about this one. I have my friend. Well, I guess I'm being a little presumptive in calling him my friend. Mike is. I'm just a fan, I guess is a better way to put it. So I'm a big fan of Mike. As you know, if you've watched my channel where I give my market updates about every 2 weeks, we talk about what's going on in the real estate market. We always refer to the Altos Research Reports, and we're looking at national, California. Then we do 6 Southern California counties. And we got the man, the myth, the legend here right now. Mike, how you doing, my friend?
Christian, great to be here. Nice to see you.
I appreciate it. I appreciate it. So, first, before we dive into some data, I have to thank you. You do live streams all the time, but today you did a webinar as the 2024 housing market forecast, and you're still here. And you're like, I do one of these, and I'm exhausted. How do you do that?
It's a big day. The good news is that we're talking about the data, and so I'm in the data a lot, so we can have the conversation about what's going on in the market, and we can
There's something I want to address, an elephant in the room, because this drives me crazy. And what it is, and I saw one of the comments today on your live stream that you did today, where people talk about how you're pandering to agents and you're basically making the message so that the market always sounds good. It drives me nuts for many reasons, and I want you to expound on this. Because number one, you don't do that. You're like one of the most accurate dudes out there when it comes to data. And number two, like, it's not your fault if the market's up in an area where somebody wants it down, or is down in an area where you want it up. So can you address that? Do you have any, do you care what the market does, whether it goes up or down?
No, my job is to be as good as I can about what's happening in the market. Sometimes people have a lot invested in their bet on where the market's going or their expectations. And when the data is counter to your intuition, it can be really hard to accept. And so then you go looking for reasons. And in my view, when the data is counter to my expectations, I go and I investigate. Are my expectations wrong? Is the data wrong? Is that, like, what are the reasons? Going to the excuse of, like, oh, well, this speaker has an agenda is really frustrating. I don't know. I guess sometimes the speaker has an agenda, but for me, what I'm trying to do is, like, it's funny because people are like, well, you're trying to make the housing market sound good, as if making the housing market sounding good helps my business. Like,
exactly.
Like being wrong helps my business. Like, I don't understand. I don't understand that logic. Like, I'm not in the business of, getting clicks. I don't get paid for my YouTube videos. Right? We get paid for our data. So, it is like, I suppose there are people who can put, like, you can put, like, really crazy headlines, and the doomer views get a lot of views.
100% agree. And that's one of the things on my channel. Like, I'm doing okay. I got 30,000 subs. You guys are doing great. You've got plenty of subscribers, but we're not always saying that the market's falling apart. That gets the clicks, that gets the comments. And the same people, literally, it's like the weatherman who's always wrong. They've been saying the market's going to crash for the past 3 years straight, and people still show up and watch these videos and believe them.
10 years, or they've been saying it for 10 years.
Yeah, exactly. And the other thing, and this is the thing from the real estate side. So you're not a real estate agent. You're not trying to get listings or to do sales. You're just selling data. For me as a real estate agent, what's annoying about it is, as much as I don't want to see values drop and see people lose their homes and things like that, like, I will do okay in any market. I've been doing this a long time. I don't care if values go up forever. I will be fine as a real estate agent. Now, of course, I don't want to see people losing value, equity, losing homes, things like that. It's very sad, but we'll be there to help if that happens. So anyway.
Yeah, and if you report that things are going up or down, it's not like you have a influence over
yeah.
It's a weird accusation. Like, people accuse me of lying, which blows me away.
No, and I appreciate you addressing this because this is something I've wanted to talk to you about because I see it on your videos and you guys ignore the trolls, which is good, but
It'd be hard to.
I know. All right. So I know this is kind of a new platform where we're streaming on because you typically use Zoom. Do you feel comfortable to share some of your slides or how do you want
Sure.
to do this?
Yeah, I can share slides.
Because I know you released a lot of great stuff today in your housing market forecast.
Yep.
So share whatever you feel is relevant and important, and we'll go along with it. I'll have some questions along the way, and we'll try to get you out of here pretty quickly. We won't
Okay.
do crazy long time.
Let's start with, so inventory is climbing across the country. And so let me just start there and then I will show, let's see.
Yeah, you're going to hit the add a source, share
Yep.
it, and then I can
I
help
think
too.
I'm all good. I just want to get to
Awesome.
my slideshow mode. Boom. Yeah.
Nice. All right, I'll get it in here. Perfect. I love this stuff. All right,
Okay.
good.
So what we have here is there are 568,000 single family homes unsold on the market across the US.
Okay.
And each line in this chart is a year. So the inventory peaks in the late summer and then it comes back down and you can see the annual curve each year there. The dark line right in the middle, that's this year. And you can see it is higher than the last few years, the red ones, and growing, but still not as many homes on the market as pre-pandemic. So you can see the gray ones at the top, 2017, 18, 19. But as rates are higher, mortgage rates are higher, that means inventory builds. So higher rates leads to higher inventory. And so what it's showing, and what we've got is rates have stayed in the sevens this year, maybe inching back below 7, but still in the sevens this year. So as rates have been higher, inventory has been climbing versus last year. And this is across the country. It is, and so we can also say that an observation is that if rates fall, let's say they fall into the sixes, into the mid sixes, you'll see demand accelerate faster than supply. And so inventory will shrink versus last year and maybe peak and crest and shrink overall for the year. So depending on how low inventory.
What do you think realistically? Because we're all excited in December. We saw the dot plots and we're thinking, okay, Fed's going to do some cuts. And obviously things have changed since then. Do you see rates dropping to 6.5 this year, in your opinion?
So I don't predict rates. I said that, like, I've been wrong on mortgage rates for 30 years.
You're consistent. I like the consistency.
It's like I bought my first house in my 20s and, it was whatever, 8% mortgage rate. And I locked in for 30 years because I thought they'd go up. And then I bought another house when I was in my 30s and I locked in for 30 years. And so like I've been wrong on mortgage rates for 30 years.
I love it.
And I'm not convinced anybody can predict mortgage rates.
No one can. No one can.
So what I can do though, is I can tell you exactly what's going to happen in the housing market if rates go up.
Yeah.
And what's going to happen if they go down. And if they go up from here, you're going to see even more inventory build. If rates stay higher for longer, like multiple years in the sevens or even the sixes, like you'll see it's multiple years, inventory will finally build back to the old normal levels of available inventory.
How dare you say such a thing? That sounds painful.
And on the other hand, Christian, like, there are folks who are on the sidelines waiting for rates to drop because they think, well, once rates drop, then it's going to loosen up and people are going to be selling houses and everything's going to be great. But the data shows the opposite is true. And I'll show you this in a second. When rates fall, inventory is going to fall. That's because there's going to be more demand. There's a lot of people on the sidelines who are waiting for that to happen. And suddenly competition is going to be higher. So if rates fall significantly, you're going to see the opposite to true. And I think there's a lot of people who are waiting on the sidelines who don't realize that that's the condition that they're facing.
I agree with you. Those are the discussions we have with folks. And literally they all say the same thing. Like they come into an open house and they're like, well, we're waiting for rates to fall. And then I'll ask them that question. Well, what do you think is going to happen? Isn't everybody else waiting as well? Don't you think there's going to be more competition? And then you see the light bulb go off and they're like, well, maybe
That's right. Like, huh? Turns out I know my brother's waiting too, and I know, like,
Yeah,
you can start to
yeah.
see that for sure. What's interesting though is so this is up across the country. Inventory is climbing pretty much everywhere across the country, but it's not climbing equally across the country. So I've got another view
Oh,
here,
wow.
and this is by state, and the percentage numbers here is how much more inventory that state has unsold than a year ago.
Wow. Look
And
at Florida, 64%. That's unbelievable.
64%. And even in Arizona is now 63% more homes on the market than a year ago. Texas, you could see Georgia at 50% more. So only 2 states have fewer homes on the market now than a year ago. New York and Nevada, and even those are climbing. So in a couple of weeks, they'll be all positive. Every state in the country will have more homes on the market than a year prior.
The disclaimer being that last year, this year over year, this is a big increase, but historically, this is not a huge amount of inventory. We're
That's
still
right.
well
In most
below.
places, it's not a
Yeah.
huge amount of inventory. In Southwest Florida, it's not huge amount, but it's more than it has been. Like it was more than like 2019. So
Wow.
so in Southwest Florida, in Austin, Texas, in a few places like that, have had a decade of inbound migration and investor builds, and now in like the southern markets there, the Gulf states, you've got rising property taxes and
Hmm.
insurance costs.
Hmm.
And so suddenly, if you bought a house and you've got a second home in Naples, Florida, and you don't use it that much, but your insurance has tripled and your property taxes are up 25%,
Yeah.
suddenly it's a lot more expensive to hold on to that house. And so some of those are getting relisted. And so and then in the inbound immigration is slowed. So
You start to see the inventory.
you start to see the inventory
And
build. So
yeah.
it's not evenly across the country. If you're shopping, I have a colleague who lives in Brooklyn and is shopping in upstate New York, and he's like, there's still no inventory. Like it's still, the Northeast is still barely like coming off of the pandemic lows still.
Well, and that's a great point to share. And that's when people are complaining in comments below YouTube videos, if it's national data, it is what you're showing. It's very different markets. You got your buddy who can't find anything, but if he decided to look in Florida, he'd have more than enough opportunities. So
That's right. That's right.
yeah,
So I've been trying to show this, nationally, 35% inventory increase this year is a pretty big deal nationally. It
yeah,
probably has implications like our median prices will like not appreciate, or maybe very little this year across the country, but it's still imbalanced. And the key is that it's inventory is climbing everywhere. And I believe that the last 2 states will turn positive in a few weeks.
yeah. So, and you can keep going on the slides as you're going with the slides. So I will say, locally, so inventory in Orange County is pretty flat year over year. We're not up that much as far as inventory goes, but Ventura, Riverside, San Bernardino, even LA, those markets have seen a big increase year over year in inventory. So this is great to see it nationally, but you still have to dive in locally. And with these Altos Research Reports, you can dive all the way down to your city or zip code, which is
That's right. Yes,
yeah,
for sure. Thank you.
yeah,
Yes, you can. We track every zip code in the country, and so another view is sort of similar, but actually makes it even a little more stark. Is if we look at how quickly we look at our pendings count each week,
yeah.
and these are the homes going into contract, and divided by the total number of inventory. And so we can turn it into months of inventory, and you can see exactly. So inventory is rising in some places, but demand is rising also
Yes.
in a lot of places sufficiently to eat up some of that available inventory. And you can see that middle of the country and Northeast, it's still very tight amount of inventory in parts of the country. And so one of the observations is that more homes on the market mean more home sales can happen.
Yeah.
Last year was so restricted. There were so few sellers, and we had very few sales as well. So now we can see the home sales start to climb a little bit. So the redder here None of these states have a lot of, a long time of inventory. Like there's still enough happening, like it's still slightly restricted, but it's you can see exactly where the markets are slower and faster in this view.
Two things. Do you still agree that 6 months is considered that tipping point? 6 months of inventory is goes into the buyer's market, and 6 months or fewer is a seller's market, or do you think that's changed as well?
Well, I think so. This is using the Altos data, which is probably a little different view than the way, for example, NAR estimates months of inventory for the country.
Yeah.
And they where we're tracking. We just track every home for sale in the country, like literally count them all.
I like how you
NAR
just
uses
rattled that off. Oh, well, yeah, we're just tracking every home in the country.
Yeah,
Like you're just
exactly.
like, oh yeah,
And
no big deal.
but NAR is like estimating, so they estimate some
Yeah.
bigger numbers than we do, and so in our numbers, you might think of 4, 5, like use a slightly lower threshold than the NAR number.
Oh, good. Actually, that reminds me, you use the market action index in your reports, and that tells you whether it's a extreme seller's market. So that I think is a better metric than looking at this. The other thing you mentioned that should not go unnoticed is just because sales were down last year doesn't mean there's a lack of demand. It was actually a lack of supply that is leading to sales being down. That is a big distinction and very different from the global financial crisis. It was a lack of demand back then, not a lack of supply, and this is the inverse of that. So,
yeah, and anyway. In fact, I mean, I would say that both of those things are true. Like demand was way down, like rates went up, demand dropped way down from the pandemic, but we were also in a supply constrained market.
Yeah.
And, one of the places you can see that now is that, in the Altos data, we are showing slight sales gains over a year ago, slightly more sales each week than a year ago, like, 2 to 5% more sales than a year ago. But if you follow, for example, the Mortgage Brokers Association, the Mortgage Bankers Association, MBA, they announce they have a tracking of like how many mortgages are we doing each week.
Yeah, the origination data.
Yeah, that data, that purchase applications data is not showing gains year over year yet. And that's probably because this year we have a lot more cash sales happening.
Yeah. That's an excellent point. And do you guys track cash sales?
We don't track the transaction that way. So I don't have that data handy, but you can see it anecdotally in actually a lot of your southern, like Orange County, a lot of your Southern California markets. Certainly I'm in San Francisco, and certainly both San Francisco and San Jose, markets are kind of hot right now.
Yeah.
Because, you've had like a strong couple of quarters in the tech stock market. People have a lot of cash and they are buying multi-million-dollar houses with cash. And so
to give you an idea,
the demand is there.
To give you an idea, Mike, and I'm sorry I keep interrupting, but I just get so excited talking to you. And it's like, I just have your reports and I just get to read your reports, but I've got you here. So to give you an idea for demand in Orange County, the median home price is up 22% year over year in Orange County, which is completely unsustainable and nuts. And what you're saying is true. Like certain spots are super hot. For what we have going for us in Orange County, because I'm doing business in Orange County and LA, a lot of people are getting out of LA. They're not happy about LA, so they're moving down to Orange County. So, and then probably in your neck of the woods, you're seeing some of the flight out of the city itself into some of the outlying areas as well, taking their cash.
Maybe, yes. There's also, like, I was speaking with a realtor friend in San Francisco this weekend, and she's like, I've done 3 deals this year, one at 5, 6, and 7 million, and they were all cash. They were all move up in the city.
Wow.
And so, these are there's that kind of thing happening. And, and down in Silicon Valley, in the San Jose market, you've got like NVIDIA is now $2.5 trillion of market cap. They have 20,000 employees in Silicon Valley,
Yeah.
And there's only, 800 homes for sale in the entire metro.
Wow.
And so there's, 20,000 people who've got like millions, who've, earned millions in that, like, and that's just one company.
Yeah,
Right.
exactly.
So that, like, there are plenty of cash offers happening there and driving that. But also you'll see I was chatting with a loan officer in Raleigh today on Twitter, and she said, we're estimating 30% of our market is all cash right now, and that's Raleigh. And so that's like a lot of people. Those are people moving with equity from California or New York or even Virginia.
And Florida. Those are the halfbacks.
The
People
halfbacks.
move.
That's
They
right.
move from New York to Florida, realize they don't want to be there anymore because of insurance, property taxes, and giant bugs and humidity. They move halfway back, and Raleigh's a great example of that.
Exactly. And they're coming with cash. And so, you can see those happening there. So I think that's a really interesting dynamic right now. And it's why some measures are showing slight sales gains this year and others are not. And it's why, when rates finally fall back down, maybe into the sixes, mid sixes, you'll see the mortgage numbers will pick up as well.
Yeah.
There is one of the questions is, okay, inventory is up 35% year over year. One of the questions we get is that like, that seems like a lot. And, does that mean things are going to crash? And how do we know? And what should we be looking for? So one of the things we do at Altos is we'll track every new listing each week around the country. So there were 69,000 new listings unsold around the country that hit the market this week. There were another 21,000 that listed and are already in contract. So it's 90,000 total homes.
Wow.
And in this chart, so where each line here is a year, and the gray squiggles are past years. The light red line is last year, and you can see we have slightly more sellers each week than a year ago. And so we were talking about that. One of the things that kept a lid on sales last year was supply, and we had record few sellers each week last year. We have slightly more than that, but you can also see that a lot of times in May, you might have 80, 90, or 100,000 sellers on the market, hit the market each week. And we had 69,000 this week.
I will tell you anecdotally, working with buyers in my neck of the woods, if you're out there and you're well priced as a listing, there's multiple offers, and it's not just under $1 million. Like you were telling them that $5, $6, $7 million story, those sales. I was talking to another agent in my office who had a listing at $5 million that had multiple offers. Actually, I think it had 12 offers, if I remember. Yeah, if I remember correctly. But yeah, it's tight. It's tight if you're priced right.
If you're priced right, exactly. And the good properties, and you can see that's, like, if you're a buyer, you want to wait for the good ones. In the hot markets, the wacky ones, even those sell. But
yeah,
in these markets, it's, the good properties that are priced well are still getting the attention. There's plenty of cash. But I think the takeaway here with the new listings, Christian, is that you can see that we don't have a flood of sellers.
Yeah.
So, for the folks who are, again, like, if they're on the fence or they have a hypothesis that the market's going to crash, one of the things that would have to happen for a market to crash is you'd have to see sellers.
Yeah.
And we have slightly more sellers, 12% more than last year, but we don't have 60% more.
Yeah.
Right. And we don't even have normal levels of sellers. It's still pretty restricted. Still on the low end. You can see most of the previous years, those gray lines are there's significantly more sellers each week than we have right now. And so this is a signal to us that inventory is not going to, the unsold inventory isn't going to balloon too big. Right. It's been growing each week, but a little bit each week. And so it's not going to get too far out of whack. It's not going to get to scary numbers. And in fact, if rates fall, we'll see inventory tighten up again. And so, like, if you have a hypothesis, like our friends, the YouTube commenters who like, think we're shilling because we want to convince the people that the market's
The
going up.
crash bros. That's
Right.
what
If
they're called. All-nighters talking about it. Market is going to move down like equity markets. Don't believe all the hype. But they've only been saying it 3 years.
And so if those folks if they want to validate their hypothesis, if they want to track their hypothesis, they could watch the new listings volume each week. I mean, I do, because if that thing moves up, if we were at 80,000 or 90,000 or 100,000 now, and then with a few more immediate sales on top, then I would absolutely be talking about, a supply demand imbalance.
Yeah.
But we're not there. And so but I want to be the first person to be able to talk about that.
Yeah. Well, on the other side of it too, Mike. So where would that inventory come from to get us to those crazy high levels? It's not going to be foreclosures. I've done foreclosure reports, and you probably don't cover it in here. We don't have the notices of default yet. Right. So we're not kicking out the REOs to lead to more inventory. New homes, there's been an increase in construction, but we see that pipeline, and the builders are doing a great job of managing the flow of properties as well. So we can't even get to the 100,000 listings unless a bunch of sellers all of a sudden decided that's it, it's time to sell. And maybe with enough job layoffs or this or that could happen.
So then you think about the job layoffs, and I think somebody asked me on this morning, and in this hypothesis, like where does inventory come from?
Yeah.
So let's say, right now we still are pretty fully employed. Unemployment's inching up, but it's still really low. We still have, everybody in the country has a job.
Yeah.
And so, okay, let's say maybe it's, another 6 months, and a job loss recession is finally here. I've been looking for it to come for 2 years. It hasn't come.
Yeah.
Right. The economy's stayed strong. So let's say it eventually comes at the end of this year. What happens is, when does the inventory come? So now I've lost my job and I can't make my mortgage payment. Or first I lose my job and then I realize, wow, it's been, 3 months and I don't have a job. And now I'm like, start to get worried about my mortgage payment. So it's another 3 months. And now I'm like, man, I am going to miss one. Yeah. That's 6 months in. Now we start the foreclosure, the default process.
Yep.
It's a year before we see the inventory after the job loss recession starts. So after you get the big job losses, now it's a year later, right? So it's probably 2026 inventory at the earliest before we would see inventory gains from a big job loss recession.
That's an excellent, excellent point. And like we had during COVID, where we had the foreclosure freezing, moratorium, and then everybody was working on their fixing mortgages and people. Anyway, long story short, if that does happen, we know the government has fixed it in the past, and unless they completely implode, there's a chance they'll fix it in the future. So if all of a sudden unemployment spiked, they would potentially have some sort of mortgage forbearance program that goes into place. We learned towards the tail end of the global financial crisis how to manage people through the foreclosure process and slow the flow down. So I agree with you. It's going to be 2026. I think it's even further. It would be 2027 or later, because the process would be well managed, unlike last time.
So, the other thing that might happen here is you could imagine a scenario where the government doesn't even have to step in. So, in previous job loss recessions, 2007 or 20 years ago, there was a little, or 30 years ago, the beginning of the 90s. At those times, people had higher mortgage rates. They had mortgage rates in the 7s or 8s or 9s, and there were a lot more variable mortgages. And so now I lose my job, and now my mortgage is not a great thing to hold on to. Like it's a big liability.
Yeah.
Right. In that time. In this time, if I've got a 3% mortgage like everybody in the country, and now I lose my job, I know that the best asset I have anywhere in my portfolio, anywhere, the only thing I want to hold on to is that house.
You're spot on with this. You
And
will pay
so
every other thing.
to save
Yeah.
that 3% mortgage.
Yeah.
Yeah. And so I have a hypothesis that even when the job loss recession hits, we're
Yeah.
still not going to see foreclosures spike, because everybody who has one of those mortgages knows it's the best deal of their lives.
That is so spot on. They will do anything to hold on to it. We saw that during the global financial crisis with short sales. Like, people kept throwing good money at bad money when it was like a 6.5 or a 7, and they were upside down 200,000 or 300,000. They're still throwing good money at bad money. But to your point, they're going to do everything they can to keep
Yeah.
that
Well, and
asset.
in that global financial crisis, so if I had a 7% mortgage, so there were like three things that need to happen for me to go into that foreclosure process, right? I lose a job and I can't get another job. So that's not true right now. Maybe it happens, in 6 months or a year, but so that's got to be the case. I have to be upside down on a lousy mortgage. So I mean, I owe more
Yeah.
than the house is worth, and my payments are big and they're ballooning, like
Yep.
bad terms on my mortgage. That's not true for anybody in the country. And
100%.
even when we lose everybody's got equity, everybody's got a lot of equity, and with the exception of, if you bought in Austin, in July of 22, you might be upside down.
Yeah.
And so there are a few pockets of people who bought in the last 2 years who are in a less, not as spectacularly good position. But generally around the country, you've got a lot of equity. You've got the best deal of a lifetime in that mortgage. So that's not true, right? And the third thing is, you got to look around like you did in 2007. You got to look around. You go like, okay, I've lost my job. I got a lousy mortgage, and all my neighbors can't sell their house either. So, days on market is at 60, 70, 80, 90 days instead of 21 days. So now I've got to have all three of those things. Like I don't have a job, I have a lousy mortgage, and I can't sell my house. Therefore, I got to walk away from this.
It's a country song. When the economy gets to a country song, lost my job, lousy mortgage, can't sell my house. When it's a country song, then we will see.
Yeah, and so none of those things are true right now. And even when the job loss recession hits,
Yeah.
even if it hits hard, the two others still aren't true. Maybe it's slow to sell your house, but you still have the great deal. So, like, my hypothesis is that even when that we'll see inventory climb with a recession, but we won't see a spike this time around. Like, I think it's another generation, 10 years of turnover before we adjust those assumptions back to a different thing.
All right, okay, I'm only going to keep you like 5 more minutes because I know you're exhausted. So let's race through and don't let me interrupt you.
Okay. No, this is great. Like, the interruption is like the conversation is right. It's terrific. One thing I shared today, and I mentioned this already, at Housing Wire, who owns Altos Research, we published a report on the mortgage rate lock-in effect. And so the lock-in effect is, we assume that people, because everybody has a low rate, like we've been talking, nobody wants to sell or nobody can sell to buy a new home. And one of the reasons that sales are low is because rates are high. We published this paper that dives into some data, which shows us that it's actually not because rates are high, it's because rates were low. And I mentioned earlier, as we were talking here, low rates, lower when rates fall, inventory falls. When rates rise, inventory rises. So people who are on the fence, thinking about waiting for rates to fall. What we've got here are on the left, the red dots on the left. These are the times when rates were falling, like the 2019 or 2015, 16 or 2017. You can see those years rates were falling, and each of those years inventory falls. But in 2018, mortgage rates rose for the year, And then, of course, the last 2 years, mortgage rates have been rising a lot. And so you see this direct relationship that when rates fall, inventory will fall. So like I mentioned earlier, I don't predict rates, but I can tell you exactly what the housing market's going to do when rates move. And we can see if rates move down a lot, like 200 basis points on the far left of the chart, inventory falls a lot. If rates rise a lot, like on the right side of the chart, 500 basis points, like it did in the last 2 years, then inventory rises a lot. And so you can see this direct correlation of what's going on. And I shared this today in the webinar. We wrote about this in this big mortgage rate lock-in report. And so people have an assumption that when rates fall, suddenly we're going to have inventory and everything's going to be better. But the data shows us that when rates fall, demand falls, demand kicks in faster, demand is stimulated faster than supply. So the total available inventory falls.
This is genius. And it seems obvious when you lay it out the way you do and you chart it, you're like, well, of course, this is what happens.
Yeah.
But it's counterintuitive until you actually look at it and have the numbers.
Yeah.
So this is great. This is great. And I can't thank you enough for being here. I'd keep you another couple hours, but I know you got to go. You got to go home. You probably have another 10 of these tomorrow. But this has been absolutely amazing. I'm going to blackmail you right now. You have to come back. So you can't say no because you're
love to come back. It's great.
All right, good. See, that was very nice.
I actually had a friend in LA today texted me with your you had an announcement blast. He's like, hey, like this, a non-industry friend.
Oh, good.
Yeah, who's on your list.
So. That's awesome. Well, he's probably on my list because I always talk about Altos Research Reports. That's how he got on my list.
Oh, he's like a friend from like he is like a personal friend.
That's awesome. Well, no, this means a lot that you did this, and we're definitely going to have you back on. And I'm going to continue to share the local data. And anybody who's watching this, make sure you sign up for the Altos Research Reports. You can sign up for one free zip code. I recommend doing that. But once you do that, it's like that free taste. You're going to eat the whole bag. You're going to want every report. We are lucky enough to have the national, California, and then the 6 Southern California counties. So we appreciate you providing that data. Mike, thank you again. And we look forward to having you back on soon.